Hello traders, Gary Wagner for Trending Markets. It is Friday, October the 2nd. Happy Aloha Friday. We have had a startling jobs report come out, way under estimate, coming in at 142,000 new jobs added, which really sent this market flying, meaning the U.S. equities markets much lower in the morning, actually off by a couple of 100 points to close up a couple of 100 points. We had a 400-point swing in the Dow Jones Industrial Average. Quite a day, to say the least. The market closes at 16,472, putting up about 200 points on the day, or 1.25% roughly. But the real issue, or not issue I should say, but the real action was the fact that just prior to the jobs report coming out, this is a 15-minute, very, very short-term chart. It's a Japanese average chart. In fact, let's convert it to a standard candlestick chart, because it will give you much more of a sense for what we saw today, because you'll get true opens and true closes and kind of expand on this a little bit so you can see just what kind of day we witnessed in the market. Now, when we take a look, this is the beginning of today's trading activity. Market opens and then trades down by about 200 points, finding support just above 16,000. Of course, we settled in this area for roughly an hour until numbers came out. And once the numbers came out, we had a slow and methodical rise from about 16,050 all the way up to 16,360. That was the only point in which we saw this market actually trade sideways for a little while, up about 100 points. And then as we got into the last hour of trading, which is represented by these four candles here, we saw this market spike to absolutely close on the highs of the day. Now, as you know, I have been looking at a real potential that we would see the U.S. equities markets form some sort of bottom, I believe, roughly by the second week of October, but it could be earlier. And over the last few trading days, we have been postulating whether or not we are seeing some sort of bottom activity in the market a little bit earlier than I had originally thought. I draw your attention to our daily chart. I've just gone ahead and pulled that up. In fact, let's go ahead and blow that up. And we identified a pattern within this market simply called a three-river morning star. And the way we were looking at this all through the week is we had the defined bottom. This came after the fiasco in which we saw this market sell off dramatically. We had the market recoup, but that was really capped by this shooting star. So to meet the criteria of a three-river morning star, the first criteria is that it is following a defined downtrend in the market. So we certainly met that criteria. We certainly saw this market move down. That was capped by a low coming in right at about 16,000 on the Dow Jones Industrial Average. And then we had the star form towards the bottom of this candle. And then the following day, we had a large green candle forming. Now, that certainly is a three-river morning star. However, the following day, meaning yesterday, we certainly didn't see this market close higher. We did have a higher high, a higher low, but fairly unchanged on the market. And that all changed today. This dramatic move up, pushing us up above 16,400, which is the area that I really wanted to see this market move above. Now, where you can really see this three-river morning star is not so much the Dow Jones Industrial, but the Standard & Poor's 500. And as you can see, I've just moved to our Standard & Poor's 500. This is the E-mini, closing up about 26 points in the day. Same net change on the day. But as I said, looking at the daily chart will really give us a strong sense or feel for the pattern that we've been talking about, which is this three-river morning star. We get the market hitting these bottoms. This is back last month, of course. And then from there, the market did recoup a little bit, moving up to this shooting star. And once we hit the shooting star, we had a defined downtrend in the market, long red candle, absolute star in the market, long green candle. So we most definitely have this three-river morning star forming. Yesterday, we did get a candle which was green, first criteria, higher high, higher low, but the body size wasn't that large. And so I really wanted to see how the jobs report would come out today, and if in fact we would see some sort of confirmation of that. Based upon that, we did see this market move up dramatically and close near the highs at around 1943 on the S&P. So traders, if in fact we do get a firmer opening in the U.S. equities markets beginning of next week, we will look to initiate long positions in the S&P. The other market that I have been looking at has been the crude oil market. We have noted that we have now entered a real period of consolidation. Market was up strongly today, up about 2%, almost $1 per barrel, 45.65. But the real picture when we look at it is that we are still trading within this defined range, with 44 being our base point in terms of lows, and the highs, most recent highs, being just below 48 at around 47 in that area. To me, now this is a daily chart. You'll really see it on a weekly chart, but it's very, very similar to the activity we saw at the top of this market when it was trading at approximately 60 plus dollars per barrel, that we had a very, very long period of consolidation before this marketplace fell out of bed. That found support at a new low down around 38, spiked up, and then went sideways once again. Now, there is absolutely no doubt in terms of oil consumption, we are going into a period of time during the year, seasonal tendencies, in which we have genuinely the least amount of oil being used. At the same time, as prices have been depressed recently, coming off of these highs at 60, moving back into the $40 per barrel area. We're now in the mid 40s. What we have seen is supply side diminishing, especially in the United States, especially the shale producing areas of the United States that aren't profitable in these lower areas. So we've got that push pull of, we've got definitely going to see lower demand, but we're also getting lower supply. My sense is that really what we need to see is how this market reacts and breaks as we approach the apex of this pennant, the pennant simply being a flag formation in which we have a flat bottom and really an ascending set of tops. In other words, a series of lower highs and equal lows. As we approach this apex, according to compression theory, what we seem to get is a release, a dynamic release of energy once it reaches the apex and either breaks above or below. Now, my sense is that we will probably break above. I'm not looking for dramatically higher prices, meaning I'm not looking for oil to go back to 100, but I do think we could see this market surge and at least come in on a technical basis and fill this gap right in here. And then lastly, I draw your attention to our weekly chart, standard candlestick format. And as I said when we looked at the daily chart, on the weekly chart, it really is a dramatic visual of the type of consolidation that we had at the top of this market when it was trading at around $62 per barrel. Then it falls, it makes this new low right in here at about 38. But now we've gone back into this sideways congestion market. We noted throughout the week that we had about 2 months of sideways trading activity before the spike down. Now we're going into 1, 2, 3, 4, 5, the fifth week. So we could easily see a couple more weeks, I believe, of sideways consolidation. And my sense is, and we'll have to see which way it breaks, but my sense is that we'll probably break to the upper end of the range with some real strong resistance at these lows that came in here, roughly at about 56 or 57. Now, depending on how the market breaks once it reaches the apex, of course, I believe will determine the overall direction. But right now, I do believe that that direction will be higher. This has been Gary Wagner for Trending Markets. We will talk to you on Monday. Bye-bye.